Alright, mortgages can be super confusing. Let's be real, it's not the easiest thing to understand. I've been in the real estate space for about 7 years and I still have to do my homework. There's so much to cover. But today, we're going to talk about interest rates. This is an important topic because interest rates impact how expensive your payment is. A low interest rate lets you have a much cheaper payment. It allows you to buy a bigger house and save thousands of dollars of interest. In fact, the difference between 5% and 4% on a mortgage could save you hundreds of thousands of dollars over the life of the loan. So, the thing on everybody's mind is, how do we get a lower interest rate? Interest rates are all about risk. The riskier the environment, the worse the interest rate. This is why people with good credit scores get better interest rates. The bank sees them as a safer investment because they demonstrate good borrowing history. Interest rates are impacted by so many factors. I'll post another video later that gets more into the details, but today I want this to be fun and easy to understand. A lot of you heard about the Federal Reserve raising interest rates and naturally freaked out because you thought that mortgage interest rates were going to skyrocket. But then something weird started to happen. Interest rates actually got better. Now, if you're a real estate professional, you may have a client calling you asking you to explain this. And you probably started to panic because the truth is, no, you can't explain it because you don't understand it either. Here's the deal. The Federal Reserve doesn't actually control mortgage interest rates. It's pretty funny because it kind of pisses them off. The Federal Reserve sets the short-term overnight rate. This impacts things like credit cards and car loans. When they increase the cost of spending money, it motivates people to spend less. This is an important tool when we're trying to fight inflation. Now, if you recall, the government printed a lot of new money into circulation. Inflation is essentially too much money and not enough things to buy. So what does that do? If there's a lot of money and not a lot of supply, it drives prices up. Mortgage rates are really impacted by inflation. Now, a lot of experts, they use the bond market as a gauge to track and predict what they think interest rates are going to do in the mortgage space. It all comes back to that boring high school econ class. Remember supply and demand? Let's refresh your memory really fast. High demand, low supply equals higher cost. Here's the deal. People tend to act like scared little chickens that think the sky's falling. When the market seems unstable or volatile, they tend to flock to bonds. They flock to bonds because they're safe, they're boring, and they can be guaranteed by the United States government, even if they don't earn as much as stocks. Now, mortgage-backed securities, which I'll give a breakdown in a future video, but essentially all you really need to know is a mortgage-backed security are a bunch of mortgages that are packaged together and sold, traded back and forth. They call this mortgage-backed securities. Anyways, mortgage-backed securities, or MBS, and bonds compete for the same investor money. The MBS market knows that they can safely set their interest rates just slightly higher than the bond market, specifically the 10-year Treasury bond. Here's where it gets weird, so stick with me. I promise, I'm about to wrap up soon. Remember our supply and demand refresher? Well, when somebody buys a bond, it pays what's called a yield. The more people that buy bonds, the higher the price of the bond gets. The more it costs to buy the bond, the less return on investment you get, or the less yield it pays. That makes sense, right? The more expensive it gets, the less return on investment you make. Let's bring this thing home. Here's where that matters. Mortgage rates and bond yields have what's called an inverse relationship. It's a fancy way of saying that if bond yields decrease, then mortgage rates tend to get better. The lower the bond yield, the lower the mortgage interest rate. When the Federal Reserve increases interest rates, it makes the cost of borrowing money more expensive and it curbs spending, fighting inflation. When inflation cools, mortgage rates tend to cool down as well. Of course, there's so much more than this that factors in, but this should be a great starting place to help you understand. If this was helpful to you, leave a comment below. And don't forget to like and subscribe. Catch you on the flip side.